What's up, traders, and welcome back to my YouTube channel, Roads of Profitability. My name is Brandon, and today we're going to be covering option trading. When I'm looking at the chart and I'm predicting that an asset is going to make a move in price, the way I look to capitalize on that is through option trading. Whether you're brand new or looking to sharpen your skills, this video is going to break it down in a simple way. So let's get to it. This is the material I'm going to be covering. What is an option? Calls and puts, strike price, expiration, option premium, exercising an option, in the money, at the money, out the money, and the Greeks. So what is an option? An option is a derivative of the underlying asset, like a stock, commodity, or index. Its price is going to fluctuate based off of the price action of that asset. The premium is the price that we pay to own the contract. The most we can ever lose is the premium that we pay. There's two types of options we're going to focus on. We're going to focus on calls and puts. With calls, it offers the buyer the right, but not the obligation to buy 100 shares at the strike price by the day of expiration. With a put, it's going to offer the buyer the right to sell 100 shares at the agreed upon strike price by the day of expiration. Let me give you this example to help you understand what a call option is. Let's say there's a property that you want to purchase and you come to an agreement with the homeowner. For a small fee, he'll give you the right, but you won't be obligated to purchase the property. We'll call that fee the premium. For $300,000, we'll call this our strike price. Within the next 30 days, we'll call this our expiration date. Within that time frame, if the house value goes up to $350,000, you still can purchase that property for $300K because that was the agreement you made with the homeowner. You can either purchase it and hold on to it, or you can purchase it and sell it immediately for the profit that you made. But let's say by the time of the 30 days passes and the home value is now below $300,000, you lose that premium or the fee that you paid the homeowner for the right to purchase it, but you don't purchase the property. This is like a call option. You're betting the price is going to go up and you're paying for the option to buy it. Now, let me give you this example of a put option. Let's say you own a property, but you're worried the house is going to go down in value. You buy an insurance policy for a small fee. Remember, we're going to call this our premium. That guarantees you can sell your house for $300,000 no matter what happens in the market. Within the next 30 days, we'll call this our expiration date. Within that time frame, let's say the value of the house goes down to $250,000. You can still use that policy to sell your house at $300K, avoiding a big loss of $50,000. But let's say within that time frame the value of the house goes up. You lose the fee that you paid for the policy to sell your house, but you keep your home because it wouldn't make sense to sell it if the value is now higher. This is like a put option. You're betting the value of the asset is going to go down and you're hoping to sell at higher prices. To reiterate, puts allow us to make money when the price of an asset is going down. Calls allow us to make money when the price of an asset is going up. The next thing we're going to go over are the Greeks. The Greeks are going to be what determines what the value of the option is based off of the movement in the underlying asset. Delta is going to be for every dollar move in the underlying asset, it's going to move the option price by that much. Theta is going to be time decay of the option, is always going to be represented by a negative number. For each day you hold that option, it's going to be subtracted from the value. As expiration gets near, theta is going to start being more significant and the value of the option is going to go down quicker. Vega is the impact of volatility on the option price. When IV is higher, the market is anticipating a bigger move and you're going to be paying more money for that option. But when IV is lower, the market is not anticipating a bigger move and the option contracts are going to be cheaper to purchase. Gamma is the rate of change in delta, and its impact is going to be felt after the first dollar. Every additional dollar, gamma is going to be added to delta, and delta is going to be bigger and bigger each time, and you're going to be making more money the more in the money the contract becomes.
What did he say?
I know that may have been hard to follow, so I wanted to give an example from an option play that I personally took. So I used the information from the Amazon 240 call that expired January 31st, 2025. We can see that for this option, the delta is 0.29. So the way that we translate that is for every dollar move in Amazon, the option contract is going to change in price by $29. Theta for this option is negative 0.41. Therefore, every day that the contract is held, it's going to lose $41 in value. As expiration gets closer, theta is going to increase and it's going to lose value faster. The way that we understand gamma is every move after the first dollar increase is going to be added to delta. So for this option, it was 0.4, and that 0.4 is going to be added to delta, and delta is going to continue to increase each dollar that the price keeps moving. This is how you can make a lot of money in the market when holding contracts that are moving in favor. Delta is continuing to increase because of gamma. Vega for this option is 0.08. This option price will lose $8 every percentage that IV loses. Inversely, this option will gain $8 for every percentage IV gains. The next thing I want to go over is in the money, at the money, and out of the money. What this refers to is the relationship between the spot price, aka the current price of the asset, and the strike price. We call this the moneyness of the option. And I also gave an example of an option chain from Amazon for calls and an option chain from Amazon for puts. We can see that here the current price of Amazon is $233.47. Everything above that price is considered out of the money. Everything below this price is considered in the money. We don't have any at the money in this option chain because spot price and strike price would have to be equal to each other to be at the money. For the put option chain, it's the inverse. So in the money would be everything above the current price, which would be all of these strike prices. Out of the money would be everything below the current stock price, would be all of these strike prices. When I'm trading, I'm typically buying options that are out of the money, and I'm hoping that they go from out of the money to at the money to in the money. And what that does is for my strategy, it gives me the best R to R, which is risk to reward ratio. Because as we can see, options that are out of the money are cheaper, and the Greeks that are built into them, they're going to benefit me most if they go from out of the money to at the money to in the money. I'm going to benefit most and I'm going to risk the least. All right, traders, thanks for tuning in. I hope this breakdown of option trading was helpful. If you enjoyed the video, hit that like button, and if you're serious about improving your trading, consider subscribing to the channel. I drop new content every week to help you navigate the markets. Have any questions, drop them down in the comments and I'll do my best to answer. Catch you in the next one. Trade smart.